everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 82, titled Risky Stocks Can Result in Challenging Decisions. We're going to use a real-life example with Axsome Therapeutics, Inc., which trades on the NASDAQ exchange under the ticker symbol AXSM. This is a trade that was actually executed by a member of the BCI community. So what is it like when we write covered calls with highly volatile stocks? It's one of those situations where there are pros and cons to this approach to covered call writing. Because of the high implied volatility, the option premiums that we generate will be very substantial. So that's the good news. Now, also, these highly volatile securities have the ability to go very high or very low. The IV does not give direction. It just gives degree. So if the price of the stock does decline substantially, that could make the premium, which we were very happy to receive initially, pale in comparison to the share depreciation. And that, folks, is the bad news. Now, let's look at it from this perspective, because that's what happened with this trade if the price of the stock moves up dramatically, leaving the strike price deep in the money. And now we're faced with a dilemma. Should we close the short call? Now, this situation is a very real possibility because a very high implied volatility stock has the ability to go up dramatically or down dramatically. In this case, we're looking at a situation where it did go higher substantially. Let's look at this real-life trade that was executed by one of our members with AXSM. On December 2nd, 2019, the stock was purchased at $33.39. That same day, immediately after the shares were purchased, the covered call was sold. And that was sell to open for the January 17th, 2020, 7-week out expiration, in the money strike with a $32.50 strike price, and it generated a real hefty premium of $12.90 per share. What happened? 2 days later, the price of the stock gapped up to $45.40, about $12 a share higher. Now, the cost to close that original $32.50 call was $20.90. So the question became, should the short call be closed? Let's have a look first at the trade structuring calculations. Now, AXSM was purchased at $33.09. The slightly in the money $32.50 strike was sold for $12.90. Again, it's a 7-week return. The intrinsic value, 89 cents. That represents the downside protection. So the time value, initial return, was 37% for 7 weeks. That's huge. Upside potential, of course, is zero because we're agreeing to sell our shares for a lower price than we're currently trading. In this case, $32.50 when the stock is trading at $33.39. So there's no upside potential. Now, we do have a downside protection of that time value profit of 2.7%. So the intrinsic value protects the time value. What that means is we are guaranteed a 37% 7-week return as long as share value does not decline by 2.7% in 7 weeks. Now, of course, that's not what happened. The price of the stock went up, and that meant that we were close to realizing our 37% 7-week return, which, by the way, annualizes to 275%. Just these numbers alone tell us that we're dealing with a highly volatile security. Now, why did the price of the stock gap up so much? So we kind of went to, looked at the news, and we found out that one of AXSM's trial narcolepsy drugs had a favorable phase 2 result. That's why the implied volatility was so high. Investors were expecting the results of this phase 2 trial, and it went favorably. So the price of the stock did go up $12 a share, leaving that 32.50 strike extremely deep in the money. Now, at that point in time, that 37% initial time value profit was looking pretty good. Wasn't guaranteed, but it was looking pretty good because the strike price was so deep in the money. So the question that was asked was, should we close the short call? Well, the cost to close was a whopping $20.90. Now, there was an intrinsic value of $12.90 with the stock trading at $45.40. That $32.50 was $12.90 in the money. So the time value component of that $20.90 cost to close was $8. Now, that represents about 67% of the initial time value profit. Are we willing to give up 67% of that initial time value profit, which, by the way, was looking pretty good at that point in time, to close the trade and move into another one? Now, the exit strategy that we're looking at here in the BCI methodology is known as the mid-contract unwind exit strategy. And when we decide on whether to close the entire trade, we say to ourselves, can we generate at least 1% more than the time value cost to close, which in this case was $8. So can we generate an additional 1% over that? The time value cost to close calculated to 26%. Now, unless we're using another highly volatile stock, I think it's unrealistic to expect that we can generate that kind of return by the end of the current contract. So in my opinion, this MCU, mid-contract unwind exit strategy, is not indicated at that point in time. Matter of fact, I think we should breathe a deep sigh of relief that the phase 2 trial did go in our direction and we didn't end up losing a ton of money on the stock side of the trade. So let's summarize now. Using highly volatile securities is risky and, in my view, not appropriate for most conservative investors who are using option selling strategies. Covered call writing is a very low risk conservative strategy. By using a stock like this, we're converting it to a highly risky strategy. What's the point? Now, when the implied volatility results in share appreciation, closing the short call will depend on what the time value cost to close is. And then we ask ourselves that question, can we generate at least 1% more by the end of the contract? To get these calculations, we use the Unwind Now tab of the Elite or the Elite Plus calculators, which is in the BCI store. I'll give you the link in just a moment. Now, most of these kind of situations can be avoided by selecting more appropriate stocks. And it's based, there's no one size fits all. It's based on what our personal risk tolerance is. For me, I look to get an initial time value return between 2% and 4% per month. Okay, and go as high as 6% per month in a very bull market environment. And I'll dip down to 1 to 2% in my mom's more conservative portfolio. So there you have it, ladies and gentlemen. I always want to remind you that we have a huge amount of free resources on our website, www.thebluecollarinvestor.com. Check out the free resources link, the Beginner's Corner tutorial, and if you go to our blog page, you could sign up for our free newsletter. Visit our store. We have a whole supply of books, calculators, spreadsheets, online videos, trade planners, online mentoring programs, all educational products which will help us master these option selling strategies. So, ladies and gentlemen, I want to thank you all so much for taking the time to listen to and in some cases view this BCI podcast number 82 titled Risky Stocks Can Result in Challenging Decisions. Folks, I hope you enjoyed this podcast and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.